Hello everyone, welcome to the channel of Trigonometry. Today is January 31st, Saturday. What an incredible week in the book. We just had one of the most incredible market movement in the history. Right here, I'm looking at the chart of silver. Unbelievable red candle. It was down over 30% intraday. Silver just basically wiped out 3 weeks of previous 3 weeks of upward movements with one large red candle. I think a lot of people got liquidated in this red candle, and I hope this is not you. Um, but this is gonna hurt. This is gonna hurt for many reasons, not just for all the people that are losing money on silver and other metals, also for the entire sentiment switch. So just showing some of my winning trades. So this one, QQQ puts, I was up over 15, 20%. And then this APP puts up way more than this. APP dropped like 16% on Friday. My actual return on this was much higher. Um, and this is another QQQ put. And I actually also shorted silver, but not on Friday, but the day before. Uh, had I held onto those silver put, I may have tripled up on these positions, um, but I'm happy with my trades. At least I'm not on the wrong side of the market. So I was able to benefit from all these trades. My account was up a lot. Um, and I think the risk of movement will continue into next week. One of the big reason I believe those risk off will continue is because of silver and all the metals, gold, silver, copper, palladium. I think a lot of institutions got liquidated in this one huge candle. So what do they do next? They will have to sell equities to raise cash to fulfill their margin requirement. That's what happened when you have the candle like this with the this kind of volume. This is what happened. Okay. Um, you're gonna have major market impact. I don't know how long it will take for the market to fully resolve this incident. Uh, but very likely in the first couple days of next week, we're gonna continue to see a lot of red in the market. And as a matter of fact, I already seeing crypto dumping. Bitcoin already at 81,000. I remember on Friday it was still at 84,000. Ethereum at 2,500. It's not looking good. So, um, it's very, very uncomfortable. It's going to be very uncomfortable for many people if you don't have hedging position or if you are heavy leverage on the long side. It's gonna be very, very painful for you. Hopefully, it's not you. Hopefully, if you watched my previous video, you know how to hedge and you know how, when the market top to take profits, at least not with leverage or margins, um, buying into the metals. Um, these are extremely, extremely cyclical instrument. For all these commodities, gold, silver, copper, uh, oil. these like corn or whatever, all these commodities, natural gas, they are very, very cyclical. And you are one big incident away from a blow up top like this. So narrative can change very, very quickly, much quicker than you can think of, especially when people are overly leveraged, or in other words, the long position gets overly crowded and you get liquidated in one day. So in the last video, I specifically mentioned the risk in the past week, the FOMC and the big tech earnings. So look what just happened. If we look at the if we look at the SPY, January 28th is the exact date of FOMC, and looks like right now this is also the exact top of the market for now. And if you look at the QQQ, maybe more obvious. So this is January 28th, the top, which QQQ made an all-time high intraday, and then it pulled back. So what exactly did Jerome Powell say in the FOMC? Well, he didn't exactly signal any kind of emerging risks that I wasn't anticipated, but he basically saying that the labor market is stabilizing and the downward risk to employment is diminishing. On the surface, that's good news, right? The labor market is good. We don't need to worry about the employment crash. So everything's fine, right? But let me tell you how Wall Street interpreted this. Wall Street take this message as if we no longer need to worry about employment, what's the other thing we should be worried about? You'll remember the Fed has dual mandate, one for employment, one for price stabilization, or in other words, inflation. So if we don't need to worry about employment, the next thing we should worry about is inflation, right? So how do we control inflation? We cannot lower the interest rate because if we keep lowering interest rate, the inflation risk is going up. I think the Fed is basically signaling that from now on, the main risk should be inflation. Even though Powell didn't exactly say those words in the meeting, and he even said we still feel like it's kind of balanced, and he couldn't say which side is more risky at the moment. He said I couldn't tell, blah blah blah, but in the transcript it specifically said employment's been stabilizing and inflation remained somewhat elevated. So those are the words. So just taking it word by word, I think from now on, the Fed, the Fed's job is mainly focused on inflation, even though they did not specifically say that. That's my interpretation, and I think that's also what the Wall Street is interpreting. So there's no longer the potential catalyst of rate cut to boost economy. Most likely, the Fed is going to keep the rate unchanged, or the bear case could be if the inflation goes up and keeps going up, Fed may raise interest rate again. And what do we have on Friday? We had the PPI data on Friday. What did the PPI data show? So look at the PPI data from December. PPI month over month, 0.5%. far above the 0.2% of the consensus. Core PPI month over month, 0.7% month over month, way above the consensus of 0.2%. PPI year over year at 3.3%, way above the consensus of 2.9%. So all these numbers are way, way above the consensus. What happened? I don't know who made these consensus numbers, but these numbers are clearly wrong. If you just look at all the raw materials, especially metals, it's been going crazy. Like silver and copper and gold basically going vertical in the past 2 months. And this is what I expected, but I don't know what the economists are looking at to have this kind of forecast and consensus. This is way off. So this is what lines up with my expectation is inflation is already coming back. PPI is the leading indicator of CPI usually because when you have the raw material price increases, it will be passed down to the consumers at some point. The consumers might not feel it right now, but at some point, these costs will be passed down to the consumers. It has always been that way. This is bad. This is terrible. This is the last thing you want to see on inflation. I think when the Fed look at this, I don't know how many Fed members gonna be like, oh, let's keep lower interest rate. I don't think so. I think in the next meeting, we're gonna see the January PPI numbers, which could be even worse. If you look at the metals run in January, if this trend keeps going like this, we have a big problem. We have a major problem. Now let's look at back to the silver, right? SLV is the silver ETF. It it dropped over 30% at the lowest point. Um, this is brutal. This is absolutely brutal. Um, a lot of people get margin called. It's impacting the stock market as well. On the surface, the reason was that the Chicago Commodity Exchange increased the margin level of all the metals for especially gold, silver, copper, palladium, aluminum, all that. The margin requirement increased from like 25% to 30%. And another thing happened. Friday morning, Trump nominated Kevin Walsh as the new Fed chair. Kevin Walsh was recognized by the Wall Street as one of the Fed hawks, which is very surprising that Trump actually picked Walsh. This was out of many people's expectation because Trump wants to lower interest rate, but Walsh is kind of hawkish, even though he agrees with lowering interest rate, but at the same time, he advocates for reducing the Fed balance sheet. What happens if we have a liquidity crisis, right? Will the Fed still bailing out everybody? And when people start to asking questions like that, people start get nervous. The risk of sentiment sets in. Markets view Walsh as a hawk who will prioritize fighting inflation and, crucially, as a figure who restores faith in Fed independence. The consequence is the dollar goes up and commodities goes down. And because of the overly crowded positioning in the metals, we have a disaster like Friday happened. Silver crashed over 30% in one day, which is the worst single day crash since 1921 in almost 100 years. So this is a very typical blow-off top. If you don't know what a blow-off top looks like, you look at silver. This is the definition of a blow-off top. I don't think we ever get back to over $100 again for silver for quite a while. We may get some kind of bounce in the next week, but I think that was the top on Thursday. So in the past few days, my account actually did very, very well because I was shorting the market as I was previously predicting um, that the market would top around FOMC, and that's where I start to place short bets. Another thing I am worried about is in the semiconductor space because we're seeing the similar kind of pricing hike in the high bandwidth memory and the DRAM sector. You see the SanDisk. SanDisk actually put up a extremely good earnings. It gapped up over 25%. And then you look, it filled the entire 25% gap all the way down and it bounced 6% towards the close, but do you really trust this bounce or is it just like a technical bounce? This huge red candle with this kind of volume worries me a lot. Will they see the candle like the silver? Probably not. But this red candle is a very, very bearish signal. And you look at some other semiconductor memory plays like this is Seagate, a big red candle. Um, Western Digital, um, Western Digital, another big red candle. These are the hottest stock in the past couple months. It has ran up so fast, so quick. Everybody's getting excited about the memory play, and uh, this may not end well. In not until we clear up all the leveraged plays in the semiconductor space. And then you look at some of the equipment plays like ASML. ASML is actually doing okay, only down 2%. So not too much because it wasn't up crazy like the other ones. Um, this is the Lam Research, 6%. That's a big candle, 6%. And there was a ugly red candle with a very long tail towards the upside. So you see a lot of selling pressure coming from above 250. So that's a warning sign. Another one is KLAC, um, earnings earnings miss, and you get punished. There was this is more like the silver candle right here. Um, it, again, it ran up too fast, too quickly. And then it will get punished, just like this. This is more look like the silver candle. Um, I'm just seeing a lot of problems right now. And another thing I want to talk about is regarding OpenAI. I know at this point a lot of people already know about the circular financing, right? NVIDIA investing into OpenAI, so OpenAI can use those money to buy the NVIDIA chips. Microsoft is investing in OpenAI, and then OpenAI is using those money to buy the cloud compute from Microsoft, and Amazon is doing the same, investing in OpenAI so OpenAI can buy the AWS cloud compute from Amazon. And then it's just getting weird. And then we have this Oracle deal that Oracle's building this massive data center in Michigan, um, which will take over 2 years to complete. And now you look at Oracle, right? Oracle's getting really ugly right now. Oracle's trading at $164. It was up over 300 just a few months ago. It got cut half, more than half. Why Oracle got punished like this? Because Oracle basically went from a high margin software business into a low margin, um, heavy infrastructure play that burns a lot of cash. Oracle's cash flow basically turned negative already. I think Wall Street is re-rating Oracle's entire business model, and this is not looking good. If you wanted to buy a stock, I would never recommend Oracle at this moment. People say, yeah, it's cheap. Yeah, but it's cheap for a reason. It has locked up huge amount of capital and cash flow into this data center that will take over 2 years to complete. By the time Oracle complete this data center, will OpenAI even be around? OpenAI may already go bankrupt by that time. So according to some of my research, OpenAI's current cash burn rate will only last them maybe over a year or so. And you keep seeing OpenAI have these new funding rounds like every other month is pretty crazy. Like why are they raising money every other month? I think they're really running out of money already. So I'm being generous saying they will keep afloat for over a year. I think they could potentially go bankrupt. Not bankrupt, but running out of cash by the end of 2026. I think a very likely outcome for OpenAI is get to be acquired by Microsoft. And then all the OpenAI contract with all these companies will be canceled. And Oracle will be left hanging, holding the bag, holding these empty data centers that nobody use. This will be a disaster for Oracle as a company. If OpenAI goes down, all these extra demand of chips and data centers goes away. And I'm not going to say the entire AI play absolutely collapse, but I think the whole industry would take a big haircut. And now the overhyped memory becomes oversupply. The shortage become oversupply. I'm still very bullish on AI in the long term, but I do see a lot of risk that is associated specifically with OpenAI. And another name that was getting heavily associated with OpenAI is Microsoft. Look at Microsoft. Microsoft lost over 10% after earnings because 45% of their backlog basically comes from OpenAI. And Mark is questioning, are those backlog actually real demand? Will they just go away? This is what Mark is questioning Microsoft. And I'm not buying Microsoft right here. I think Microsoft very likely going under $400 or even fill this gap entirely at 392. Um, I'm I'm very worried. But will I sell every investment in my portfolio related to AI? Probably not, but I will remain hedged. Again, join my Discord channel to get the information regarding my hedging strategy. but I'm very, very worried. Wanted to hedge my risk exposure to the AI infrastructure place. For next week, my playbook is still very, very simple, which is to short the bounce. I'm I'm very bearish going to next week until I see a confirmation or the real fear starts to get into the market and we got a final liquidation flush. That's where I close my hedge, I think. But until then, I am remain hedged. I think the risk right now is still very, very big. We still have too much hype in certain names. Until we get those hype out of the way, um, I'm remain hedged. So that's all for today. Thank you. If you have any questions, opinions, please leave in the comment section below, and I'll see you next time. Bye.